It's been one of those weeks again. I feel like I've been saying that quite a lot recently, but equities taking a big lurch lower once more yesterday, and the S&P is actually on track for its worst week since the aftermath of Liberation Day back in April. It was frankly an ugly session for risk yesterday. The S&P had been up by as much as 2% intraday. We then closed about 1% lower on the day. A very, very ugly reversal indeed, and we actually closed the day, and we trade this morning at 65.70 in the S&P future, bang on the 100-day moving average, which is obviously a big level that the bulls will be looking to defend, and actually one where I would personally be looking to potentially step in and buy the dip. As for catalysts behind that reversal, really in keeping with what we've seen recently, there was no smoking gun. There was no obvious trigger to spark that move lower. Some would point potentially to a hawkish repricing of Fed policy expectations on the back of the September jobs report, which was solid enough with 119,000 jobs having been added. Unemployment up to a new cycle high, yes, but that was driven by higher labour force participation. But I'm not sure I buy the argument that a hawkish repricing of policy expectations is behind all of this, given that the market still prices terminal at 3% in the middle of next year, which is where we've been pricing terminal for basically the entirety of the cycle. And frankly, whether they cut in December or not shouldn't matter too much to overall risk appetite. You then look at potentially other catalysts. Of course, enthusiasm around the whole AI frenzy has faded quite considerably of late. We did have earnings from Nvidia out earlier in the week on Wednesday, blowout earnings from the world's most important stock. That's not my moniker, let me be very, very clear. And they did seem to soothe concerns a little bit, but those concerns clearly have come back. And I think investors are taking a much more discerning view of the whole theme. It's gone from a mindset of all capex is good capex to a mindset of actually when are we going to get a return on some of this investment. So that's a potential trigger. There's also likely some hedging activity. We see the VIX trading north of 25. That's almost certainly being driven by increased demand for downside protection. But I think perhaps the most important catalyst behind all of this is just a general lack of conviction among market participants. We are a week out from Thanksgiving. We are 3 or 4 weeks from everyone going, right, I'm done and dusted for 2025 and I'm closing up my books. And in that sort of an environment, of course, participants are going to look to protect the gains that they've made this year, and the desire to step in and buy that dip is going to be lower. Having said that, I do think the fundamental bull case for equities remains a solid one. Earnings growth is still strong. The economy remains resilient. The policy backdrop is getting looser and a calmer tone on trade continues to prevail. So while conditions are indeed very, very choppy at this moment in time, I think the path of least resistance does continue to lead to the upside, and markets, once we get through that noise, should be able to refocus on that bull case once more.